3 years ago, most people had never even heard of ChatGPT, and the idea that artificial intelligence would upend entire industries felt like something out of science fiction, reserved for tech enthusiasts and futurists, not everyday investors. Then November 2022 hit, and within months, a handful of companies exploded in value while everyone else watched from the sidelines, wondering what they'd missed. NVIDIA jumped from a $300 billion company to over $2 trillion in market cap. Microsoft added a full $1 trillion to its valuation. Early investors who got positioned before the mainstream caught on built the kind of generational wealth that reshapes a family's entire trajectory. Most people missed it completely. They heard about AI, thought it sounded interesting, maybe even messed around with ChatGPT a couple times, and then went right back to their normal lives, never connecting the dots between a technological shift and an actual investment opportunity. By the time it became obvious to everyone, the easy money was already gone. That exact same pattern is playing out right now with a technology most people still aren't taking seriously. And the window to get positioned before mainstream attention catches up is closing faster than most people realize. NVIDIA's CEO recently said something that should have made headlines everywhere, but barely registered with the public. He said the ChatGPT moment for general robotics is right around the corner. Not in 10 years, not in 5, but now, in the immediate future we're already living through. Coming from the person running the company that powers most of the world's AI infrastructure, that statement carries real weight, and the numbers coming out of the industry back him up completely. Take autonomous vehicles, one of the most visible applications of robotics technology. In 2020, Waymo was running maybe a few thousand driverless rides a week, an impressive tech demo, but hardly a commercially significant business. By mid-2023, they'd scaled to about 10,000 weekly rides across their operating cities. By the end of 2025, they crossed 450,000 weekly paid rides, a 45x increase in just 2.5 years. They're now averaging over 1 million rides a month, running nearly 2,500 robotaxis across multiple cities, and have raised over $16 billion in funding at a valuation north of $125 billion. Their target for the end of 2026 is 1 million rides a week, essentially quadrupling their current volume, while simultaneously expanding into 20 more cities, including international markets like London and Tokyo. This isn't a company running pilot programs and hoping for the best. This is a company operating at commercial scale with a clear runway for massive expansion. And they're just one slice of the broader robotics revolution. Amazon tells an even bigger story about what's happening behind the scenes in industrial automation. Back in 2019, Amazon had roughly 200,000 robots working across its warehouse and fulfillment network. In July 2025, they announced they deployed their 1 millionth robot, a 5-fold jump in just 6 years. Their robot population now rivals their human workforce, which sits around 1.5 million people globally, and 75% of Amazon's deliveries now involve robotic assistance in some form. They built an AI system called Deep Fleet that coordinates their entire robot fleet, boosting travel efficiency by 10% and enabling faster, cheaper deliveries. Their newest fulfillment center in Louisiana runs with 10 times more robots than a traditional facility and needs roughly half as many human workers to process the same order volume. Amazon plans to roll this design out across 40 facilities by the end of 2027, expecting to bank over $12 billion in automation-driven savings between 2025 and 2027. This isn't speculation about some imagined future. This is happening right now, at massive scale, inside companies that touch your daily life. The only real question is whether you position yourself before the acceleration becomes obvious to everyone or after, when the opportunity looks completely different. Here's why 2026 specifically is shaping up to be a critical turning point for this technology and the investment opportunities around it. The Trump administration has made robotics a strategic priority and is backing that up with real policy action and federal resources. Commerce Secretary Howard Lutnick has been meeting directly with CEOs from Boston Dynamics, Aptronik, Tesla, and other major robotics players. According to multiple credible reports, the administration is preparing an executive order on robotics, laying out a comprehensive national strategy to speed up American development in this space. The Department of Transportation is standing up a dedicated robotics working group. Congressional Republicans have proposed creating a National Robotics Commission as part of defense authorization legislation. The federal government is committing billions of dollars across several fronts: autonomous military equipment, including drones and unmanned systems, manufacturing automation to support reshoring efforts, and robotics R&D to stay competitive with foreign rivals. A Commerce Department spokesperson put it plainly: the administration is committed to robotics and advanced manufacturing because they're central to bringing critical production back to the United States. But the single policy move that may have the biggest immediate impact on investment flows happened on July 4, 2025, when the administration signed the One Big Beautiful Bill Act into law. Buried inside that massive piece of legislation are 3 provisions that have quietly sparked a surge of manufacturing sector interest in robotics. The bill restored 100% bonus depreciation on equipment purchases through at least 2029. That means a $200,000 robotic system that used to be written off over 5+ years can now be fully expensed in year 1. Before this bill, bonus depreciation had been shrinking, down to 40% in 2025 and on track to vanish entirely by 2027. That made automation investments risky for companies running thin margins, since the upfront cost wouldn't generate immediate tax relief. Now the math has completely flipped. From a pure tax efficiency standpoint, robotics and automation equipment have become some of the best capital investments a manufacturer can make. An ROI calculation that used to take 5 years to pencil out now works in year 1, removing one of the biggest barriers that had been holding back American manufacturers from adopting this technology. This matters because policy drives capital allocation at scale. When the government builds massive incentives around an industry, money flows toward it, not because investors are following orders, but because the economics suddenly favor that direction. And when money floods into a sector, asset prices in that sector tend to climb as competition for good investments heats up. China figured this out years ago, which is exactly why its robotics industry has built a lead that now threatens American competitiveness. The Chinese government has been subsidizing robotics companies for over a decade through its Made in China 2025 initiative, and the policy frameworks that followed, treating robotics as a strategic national priority rather than just another industry. The results of that sustained push are genuinely staggering. China now has over 2 million industrial robots running in factories nationwide, more than half of the entire global installed base. They have roughly 4 times as many industrial robots as the United States, and the gap keeps widening. In 2024 alone, China installed 295,000 new industrial robots, 54% of global demand, and a new annual record for any country in history. What's even more striking is how fast they got here. China's robot stock doubled in just 3 years, from 1 million units in 2021 to 2 million in 2024. For the first time ever, Chinese domestic manufacturers sold more robots than foreign manufacturers inside China's own market, capturing 57% market share, up from just 28% a decade earlier. They've gone from importing nearly 3/4 of their robots to producing more than half domestically. On humanoid robots specifically, the category that may represent the next major wave of robotics, China's lead is even more pronounced. According to Morgan Stanley Research, China has filed 5 times more humanoid robot patents than the US over the past 5 years. An estimated 87–90% of the roughly 13,000 humanoid robots shipped worldwide in 2025 came from Chinese companies. Industry estimates suggest more than 140 domestic Chinese manufacturers are now producing over 330 different humanoid robot models. This concentration of capability carries real strategic weight. China's robot density, the number of robots per 10,000 manufacturing workers, has reached roughly 470, now exceeding both Germany and Japan, and far ahead of the US, roughly 295. In plain terms, Chinese factories are significantly more automated than American ones, which affects everything from production costs to manufacturing quality to supply chain resilience. The US installed only about 34,000 industrial robots in 2024, while China installed nearly 9 times that. That gap is exactly why the federal government is now mobilizing resources around robotics with an urgency not seen since the early days of the space race. This isn't just about economic growth or job creation. It's about not handing an entire technological revolution to a geopolitical rival whose interests don't always align with ours. One analyst put it bluntly: China has become the world's central robotics power by building factories and supply chains that scale automation at unprecedented speed, while the US is still leading in AI software, but falling behind in the physical applications that actually touch the real economy. So what does all this mean for investors trying to position themselves for what could be one of the biggest technological shifts of the coming decade? Historically, whenever governments commit serious resources to an emerging technology sector, early investors in that space tend to do very well over the medium and long term. The internet boom followed decades of government investment in networking infrastructure and research. The semiconductor industry grew alongside sustained defense spending on computing capability. The renewable energy sector expanded dramatically once tax credits and policy support made previously uneconomical projects suddenly viable. Robotics is now entering that same phase of government-backed acceleration, but with extra urgency, driven by international competition that didn't exist in the same form during those earlier transitions. There are several ways to position yourself for this, depending on your risk tolerance, your timeline, and how directly you want your portfolio exposed to robotics specifically. The most diversified route is investing through ETFs that give you exposure to the broader robotics and automation industry without needing to pick individual winners. BOTZ, for example, holds over 50 stocks spanning robotics, automation, and autonomous vehicle companies, spreading risk across many companies and sub-industries. ROBO takes an even wider approach, covering roughly 77 companies across the full automation spectrum, including smaller and mid-cap names that carry more growth potential, but also more individual risk. If you think military and defense applications will pull in the most near-term government spending, there are ETFs focused specifically on aerospace and defense, companies that stand to benefit from increased spending on autonomous military equipment, drones, unmanned ground vehicles, robotic logistics systems, and other applications the administration has explicitly prioritized. Since military use often drives early-stage development of technologies that later go commercial. This is another way to get robotics exposure through the defense budget channel. For investors focused on the manufacturing angle, which may see the biggest direct boost from the new tax incentives in the One Big Beautiful Bill, industrial sector ETFs offer exposure to companies that either build automation equipment or stand to benefit heavily from widespread robotics adoption across American factories. Then there's what you could call the infrastructure layer, the stuff that powers all robotics, regardless of which individual companies ultimately win. Semiconductors are essential, since every robot needs computing chips, and the more advanced the robot, the more advanced the chip. Data center companies matter because robotics generates massive amounts of data that has to be processed, stored, and analyzed. Whether that's sensor data from self-driving cars or operational data from warehouse robots coordinating their movements. AI infrastructure is critical too, since physical AI, artificial intelligence embodied in robots, rather than running purely on computers, requires serious computing power, creating demand for the companies supplying that capacity. The upside of investing at this infrastructure level is you don't have to correctly guess which specific robotics companies will dominate. You're simply betting on rising activity across the whole sector, which seems like the safer bet given the trends we're seeing. Some analysts have started calling 2026 the potential iPhone moment for humanoid robots. The year they shift from lab curiosities and staged demos into actual commercial deployment at meaningful scale. Chinese manufacturers like UBTech, Unitree, and Kepler have already placed humanoid robots on assembly lines at EV makers, including NIO and XPeng, where they handle assembly and quality inspection tasks alongside human workers. Early data from these deployments points to measurable productivity gains, which builds the business case for wider adoption. Whether that specific 2026 timeline turns out exactly right or slightly optimistic, the capital pouring into the broader robotics space is undeniable and accelerating. Global funding for robotics startups hit record levels, topping $7 billion in 2024, and 2025 looks to have surpassed that. Early-stage robotics investment in both the US and China ran roughly 5 to 6 times higher than in Europe, a sign that the two tech superpowers are both racing hard to dominate this sector. Here's what I want you to understand about opportunities like this, and how they tend to play out over time. The people who built serious wealth from the AI boom didn't necessarily predict exactly how artificial intelligence would reshape the economy. or which
This
specific
process
applications
helps
would take
improve
off
your daily
first.
productivity.
They didn't need to correctly
Consistency
forecast
is
that
key to mastering
ChatGPT
this
would
skill.
become the fastest
Today,
growing consumer
we will
app in
explore
history,
some simple
or that
steps.
enterprise AI
This
adoption
process
would accelerate
helps
the way
improve
it
your
did.
daily productivity.
They simply recognized
Consistency
something
is
massive was
key to
unfolding
mastering
early
this
enough
skill.
to get positioned
Today,
before the
we will
mainstream caught
explore
on.
some simple
Then
steps.
let time and compounding
This
do the
process
rest.
helps improve your daily
Right now,
productivity.
robotics feels to most people the way
Consistency is
AI
key
felt
to
in early
mastering this skill.
2023.
Today,
Interesting,
we
but
will
not
explore
urgent.
some simple
Potentially
steps.
huge, but probably
This
still far
process
off.
helps improve
Something
your
to keep
daily
an eye on,
productivity.
not something demanding immediate
Consistency
action.
is key to
The
mastering this
DMOS look
skill.
impressive, but
Today,
the commercial
we will
applications
explore
still
some
feel
simple
distant from
steps.
everyday life.
This process
That
helps
gap
improve
between
your
where the
daily
technology
productivity.
actually is and where most people
Consistency
think it
key
is,
to mastering
that's
this skill.
exactly where investment
Today,
opportunity
we will
tends to
explore
live.
some simple steps.
By the time a trend becomes
This
obvious
process
to
helps
everyone,
improve your
by the
daily
time it's constant
productivity.
mainstream news and
Consistency
your
is
coworkers
key
are
to
asking
mastering
whether they
this
should
skill.
invest, the
Today,
early stage
we will
opportunity
explore
has
some
usually
simple
already
steps.
passed.
This
Look at how
process
fast
helps
these numbers have
improve your
moved
daily
in just the last
productivity.
few years.
Consistency
Amazon went
is
from
key to mastering
200,000
this
to
skill.
1 million robots
Today,
in roughly 6
we will
years,
explore some
and they're
simple
planning to
steps.
expand that fleet dramatically
process
while
helps
cutting
improve your
hundreds of
daily
thousands of
productivity.
workforce positions along the way.
Consistency is key to
Waymo went
mastering
from
this
10,000
skill.
to
Today,
450,000
we will
weekly
explore some
rides in
simple
2.5
steps.
years, and is
This
now
process
targeting
helps
another
improve
doubling
your
or
daily
more within the next
productivity.
12 months.
Consistency
China's
is
robot
key to
stock
mastering
doubled in
this
3
skill.
years, and they're
Today,
now
we
installing
will
robots
explore
at
some
nearly
simple
9
steps.
times the American rate.
This process
The federal
helps
government
improve your
just
daily
created the largest
productivity.
automation tax incentive in
Consistency is key
decades.
to mastering
Robotic
this skill.
startup funding
Today,
keeps hitting
we
new
will
record
explore
highs.
some simple steps.
This isn't distant
This
speculation
process
about
helps
technology
improve your
that might
daily
work someday.
productivity.
This is a current
Consistency
trajectory
is key
with
to
massive
mastering this
tailwinds
skill.
from both market
Today,
forces
we
and
will
government
explore
policy,
some simple steps.
unfolding in real time
This process
while most
helps
people stay
improve your
focused
daily
on other
productivity.
things. Now,
Consistency
I want to be
is
upfront
key
about
to
the risks
mastering
here,
this skill.
because this wouldn't be responsible
Today, we will
analysis
explore
without
some
acknowledging
simple
them.
steps.
Robotics as
This
an industry
process
isn't
helps
profitable
improve
yet
your
for many
daily
of the companies
productivity.
operating in it, and some of them
Consistency
never
is
will
key
be.
to mastering
The
this
technology
skill.
is expensive
Today,
to develop,
we will
hard to
explore
deploy
some
reliably,
simple steps.
and demands ongoing
This
investment
process
in both
helps improve
hardware
your
and
daily
software.
productivity.
Integrating it into existing
Consistency is
workflows
key to
is
mastering this
complicated
skill.
and often harder
Today,
than companies
we will
expect going
explore
in.
some simple steps.
Some robotics
This
companies that
process
look
helps
promising today
improve your
will
daily
fail,
productivity.
and telling winners from losers ahead of
Consistency
time
is key
is
to
genuinely
mastering this
difficult,
skill.
even for
Today,
people who study
we will
this sector
explore some
professionally.
simple steps.
Markets can stay
This process
disconnected from
helps improve
fundamentals
your
for a
daily
long time,
productivity.
meaning that even if you're right
Consistency
about
is
an
key to
industry's
mastering
long-term
this skill.
direction, you might have to wait longer than you'd like to see that reflected in prices. And just because an industry has government backing and favorable policy doesn't guarantee every company in it succeeds. Government-backed sectors have produced plenty of failures right alongside their winners throughout history. The Trump administration could shift direction on robotics policy. Regulatory hurdles could slow adoption. Competition from China could intensify in ways that favor Chinese companies over American ones. Plenty of things could unfold differently than current trends suggest, and the future has a habit of surprising even careful analysts. The current labor market also adds political complexity. The administration wants manufacturing to come back to the US, but robotics means those reshored factories might not create as many jobs as politicians are promising. That tension between automation and employment could spark backlash that slows policy support down the line, and it's worth watching how that plays out. But here's the real question you need to ask yourself as you decide where to put your attention and your money. 5 years from now, when robots are potentially everywhere, in factories and warehouses, on roads and in delivery fleets, maybe even in homes handling household tasks, will you wish you'd positioned yourself before the mainstream caught on? Will you be the person who recognized this pattern repeating from the AI boom and acted on it? Or will you be the one watching from the sidelines again, wondering why these opportunities always look obvious only in hindsight? The last major tech revolution created a whole new generation of millionaires and billionaires, and it did it in a remarkably short window. People who bought Nvidia at $30 before the AI boom saw returns that would have seemed impossible in traditional markets. People who recognized that artificial intelligence wasn't just hype, but a fundamental shift in how work gets done across nearly every industry were rewarded handsomely for that call. That same pattern appears to be repeating with robotics and physical AI, with many of the same forces that drove the first wave of AI wealth now showing up in a new technological domain. The infrastructure is being built at unprecedented scale. The government is committing resources with an urgency shaped by international competition. Capital is flowing from venture funds and corporate treasuries into robotics companies at record rates. Adoption curves are shifting from experimental to commercial. Most people will wait until this is obvious to everyone, until friends are talking about robotic stocks, until it's wall-to-wall financial news coverage, until the returns have already been captured by earlier investors. By then, the landscape will look completely different, and what's left will be leftovers, not prime picks. I'm not telling you what to do with your money. That decision always belongs to you, and you should always do your own research before investing in anything. What works for one person's financial situation might be completely wrong for someone else's, and I'm not qualified to give you personalized investment advice. What I am telling you is that something genuinely significant is happening right now in robotics and automation, backed by trends that appear likely to keep accelerating. The people who spot transformational shifts early have historically been rewarded for that recognition, while the people who wait for absolute certainty typically end up paying a premium for their caution. The ChatGPT moment for robotics isn't coming someday in the distant future, when we'll all have plenty of time to prepare and get comfortably positioned. According to the people actually building this technology, the CEOs, the engineers, the investors who have dedicated their careers to this sector, that moment is happening right now. The only question is whether you'll recognize it in time to act.